So this is the Canadian Mortgage and Housing Corporation, the CMHC Mortgage Industry Report. It has some data and insights onto the real estate market via mortgages and contains things such as what share of the mortgage market is in what specific term and what kind of lenders have what share of the mortgage market. And it includes some analysis of these figures. I'm going to go over things that I found interesting in this report that relate to today's real estate market and mortgages. Let's start with mortgage term. So this is, are consumers choosing fixed rates or variable rates, and for how long? And it's a very telling fact to look at because it's based partly on what mortgage lenders are pricing their different terms at, but also what is in the mind of the consumer when it comes to interest rates in the future and the real estate market. For example, as of January 2023, the most common type of mortgage term selected was a fixed rate between 1 to 3 years, which is interesting because usually the go-to is the 5-year term, and that's usually the 5-year fixed. But that has actually been nosediving the past 2 years. Right now, the most popular is fixed from 1 to 3 years, and then just under that, you have fixed rates from 3 to 5 years. And that's just up to 5 years, not including the 5-year term. And there are two reasons for this. One, it is actually more expensive to go variable right now than it is to go fixed. And usually this is not the case. There is a risk involved with going variable because you are risking that the rates might rise. And so usually you would expect to pay a little less because you're taking on that risk. And of course, there's also the offset of the reward, which is that rates can go down. But as of right now, you are paying more to take that chance. So with fixed rates being cheaper, they are seen as more attractive to clients. Now, why are shorter terms being chosen versus the classic 5-year term? And this has to do with rate expectations. This is something that the report goes over as well. There is an expectation that interest rates will fall in the near future. And currently, most estimates are putting that at 2024. And this is not an expectation that is held just by the consumers. This is the Bank of Canada Market Participant Survey, and it's where they ask some of the biggest players in the finance industry a couple of questions. And the median response was that they do expect rates to fall in the short-term future. And now the Bank of Canada can run that survey again, and maybe those institutions will change their answer because they've taken into account new information. At the end of the day, nobody can predict interest rates, especially with 100% accuracy. And these are exactly that, just predictions. But there is a reason for these sentiments to exist. With the rising debt levels and the rising interest rates, so it makes it harder to service those debt levels, it's no surprise many see a recession coming up. And the theory would be interest rates have to drop to deal with that recession. Even if that's not the case, some probably believe that the interest rates we have right now are elevated and a return to normal would be a certain level below the rates we have right now. The short-term fixed is sort of the best of both worlds. The only reason someone would go variable today is because they believe rates are going to go down in the future and they want to ride those rates down. But that comes at a high premium. The reason why someone would go fixed today is because it's cheaper, so you're paying less to be at a fixed rate. So a short-term fixed allows you to renew your mortgage rate in the short-term future, hopefully at lower rates, and you also pay less than a variable for this option. The two asterisks on this strategy would be that you need confidence in the opinion that rates will be lower in the near future, and of course there's the issue with timing. Is that 1 year from now? Is that 2 years from now? This is not to sell you on the short-term fixed rate. As a financial professional, you need to be agnostic to the market options and choose the best one for the client. And that's why there's no general right answer when it comes to mortgage term, because you need to tailor that mortgage for your specific needs. But I did want to explain the thesis of the market and why the short-term fixed has become very popular. So a very short one for today. I know I only went over one chart, but I will have a part 2 to this video, hopefully today or tomorrow, and you will see more information from this report in that video. Thanks for watching.